Very good afternoon. My name is Vinay. I'm from Bristol, India. So the next session is on financing of the Indian target of 175 gigawatts of renewables. Can I ask all my panelists to come on stage, please? So the way we will structure this, if my panelists agree, if all of us can introduce ourselves in 30 seconds each, and then I will throw the floor. I have a quick presentation to make to lay the context of how these projects are being financed and what are the challenges, and then I'll throw the floor open to invite your comments. Yeah? So you want to start?
Yeah. My name is Christian. I have, I'm involved in the sustainable energy space, but far more focused on advanced biotechnologies. I also co-chair the Climate Change Task Force in FICCI, and I'm also chairman of the Skills Council for Green Jobs, which encompasses everything, not just renewable energy, but green construction, green transport, waste management, etc.
Good afternoon. My name is Anand Rohatgi. I am Managing Director of Synergy Consulting India and Vice President Global. We are a boutique financial advisory firm, and we specialize in financial advice for large infrastructure projects globally. We are the financial advisor to the DWAS 2.99 cent tariff. So and we're also advising our international clients and projects in India. So we're happy to share some more learnings on that as we move forward.
Good afternoon. I'm Danish Verma from Yes Bank. Yes Bank is India's 5th largest private sector bank. We have a balance sheet size of around $20 billion and a market cap of $6 billion. We are the leaders in funding renewable energy in India. Cumulatively, over the last decade, we would have funded close to 4 gigawatts of renewable energy capacity in the country. We were also the first Indian institution to do a green bond, to do a green bond and a masala green bond. I'm part of the sustainability and the investment banking team there.
Good afternoon, everybody. I'm Vivek Sharma. I lead the energy and natural resources practice in CRISIL. We work very closely with the government on the various policy initiatives, including Power for All, and right now we are working on the solar mission renewal as well as GBI for renewable sector. We therefore work very closely with investors, especially lenders and private equity firms who are interested to invest in India in terms of due diligence and sector insights. Yeah.
Okay, over to you, Girish.
Hi everybody, I'm Girish Rimali. I'm the Director of Climate Policy Initiative India, and I thank MNRE for inviting me to this event at the last minute. We really appreciate it, and hopefully we can add our perspective. Just to give you a brief background on what we do, we are essentially a think tank focused on clean energy finance and policy. We look at 3 different things. At a very high level, we talk to investors all the time to understand their perspectives and their strategies regarding investing in clean energy in India. And based on our understanding of the risks they face, we look at 2 different solution mechanisms. One obviously is the policy side of things, but increasingly we are looking at financial instruments, which is pathways to enable flow of attractive capital to clean energy in India, and I'll talk a little bit more about that. Sure. Again, thank you very much for inviting.
Okay, thank you. So as I said, I'm just going to make a quick presentation. We are running short of time. So I'll be really quick with it just to lay the scene in terms of how projects in India are structured, how are they financed, and what are some of the challenges going forward. So just a quick 15-second introduction to Bristol, India. We are a specialized renewables-focused consulting and research company. We work with everybody in the private sector across the whole value chain, developers, contractors, equipment suppliers on a number of strategic policy and financial issues. We also have a most extensive database covering both utility scale and rooftop, wind and solar, and provide a lot of market intelligence and research to all the stakeholders in India and abroad. So these are just some of our clients we've been working with. This slide essentially just lays the focus and the context most of which actually Paolo talked about in the earlier presentation. The key thing here, and when we talk to many of the international investors, particularly about the Indian renewable sector, is that the fundamentals for the sector are so compelling. When you look at the imperative to reduce carbon emissions, the growing power demand, the desire to reduce energy costs, as well as to provide power to people on a 24/7 basis across India, the fundamentals are so strong that unlike in the West, we see a very a strongly growing renewable power sector over a 1 or 2 or more decades in the future. So the key here is the Indian renewable market provides visibility, it provides growth, and it provides strong government support, which I think should be all huge positives for all the financiers in the sector. Now, I think a few numbers have been bandied about in terms of what the sector needs in terms of financing. Very broadly speaking, we think that the total financing requirement for the sector is about $120 billion based on today's cost of installing and setting up these systems. Now, that is very roughly split between equity and debt in the ratio of 25-75. Most of that investment is geared towards power generation, which is being dominated by the private sector. And of course, there also needs to be a lot of ancillary investments in transmission, distribution, and upgradation of the grid, which is currently led by the public sector. Now, the key thing is, historically, the sector has been about 5 to 7 gigawatts a year. Going forward, we want to scale that up to 10 to 15 gigawatts a year. Is India and the investors ready for making this sustainable on a long-term basis? Is there enough appetite in the financing market to support this growth? I was actually very interested to see in Paolo's presentation that all the challenges that he listed, financing was not one of the challenges listed there. So that's interesting to see. Now, in terms of just to lay a broad structure of a project, how it is, how the risks are split between various entities and how these projects are financed, this is how we broadly see it. The biggest risk, in my view, for any entity who is setting up a renewable project is the ability of the grid to absorb, evacuate, and sell that power onto the ultimate consumers. There have been some incidences of grid curtailment, and the huge amount of work needs to go into making the grid strong and resilient enough to cope with the growing renewables capacity in the country. As things stand, renewables is provided a must-run status, but because of various reasons, developers are being asked to take some of that risk. And really, if Indian government wants to attract enough private investments, it needs to make sure that developers don't have to take this risk, and the transmission grid is capable of coping with with increasing supply of renewables. So that is risk number one. Second risk, which again, particularly international investors are most worried about in India, I think Jose mentioned it, is the payment risk of the distribution companies across the country. These are distribution companies which are still, by and large, government-owned. They have various pressures, commercial, political, regulatory pressures, to keep tariffs low. Their balance sheets are not very strong. So again, the question really is, can these distribution companies make sure that they can absorb all this growing capacity in the country? Can they pay for all this power on time, in line with the expectations of the investors? The other key risk is, again, from an international investor point of view, is the rupee depreciation risk. The PPAs, all the operating costs, these are all structured in rupees. When you're coming from outside, there's a genuine concern what happens when the rupee depreciates. Rupee has been volatile over the last 6 to 7 years. But I think over a period of time, driven by the attractive fundamentals of the market, many international investors have got comfortable with the rupee depreciation risk. This is something that you can build into your financial model. You can quantify it. And of course, it has an impact on the cost of power, but ultimately, investors are happy to take a view on that. The other risk is refinancing risk. I mentioned it there because despite debt for these projects being structured on a 15 to 20-year basis, the cost is usually on a floating rate basis. And when your PPA has a fixed tariff, the issue for the developers is how do they cope with any potential interest rate variations at a later date. So that is always a challenge. Fortunately, we've been in a declining interest rate trend over the last 3 to 4 years. And we are yet to see what happens if the interest rate cycle starts moving in the opposite direction. Final thing, construction and operating risk. Usually solar, everybody says solar and wind are mature technologies. They are very, with low complexity, very easy to set up. The issue there, of course, is that there's a huge commercial pressure on the developers to optimize and reduce the cost as much as possible. There's a lot of equipment coming from outside India, and there is, and on the basis of some anecdotes, there is some concern. Is construction of these projects robust enough to make sure that these are operating and they will, to make sure that these give the desired output over the next 25 years? So that is, very broadly speaking, the risk mitigation structure. Now, who is playing in the market? We see a huge interest from both the international and the Indian community to finance these projects. We segment these developers broadly in 3 buckets: international developers, private equity, and Indian corporates. The interesting thing is that it is the Indian corporates and the private equity funds who have dominated the market, unlike, contrary to what we thought would happen, because international investors bring big balance sheets. They arguably bring cheaper cost of money, but we see it is the Indian players who've been most aggressive in the market. The implication and the connotation there is, of course, what happens to these investors over a period of time. Most of these Indian developers they don't arguably have a long-term view. They want to churn their assets. They want to recycle their funding. Is there enough depth in the market to be able to absorb and fund these assets on a long-term basis is really the question mark. So far, we have seen a few M&A transactions, a sole IPO of a renewable developer in the country. So that is another kind of key concern for the sector. Debt for the sector is mainly coming from Indian lenders who seem to have huge appetite. As I think the panel before this suggested, there is sufficient appetite amongst the Indian lenders and financial institutions to support the growth of the sector so far. But the key is obviously, we need to scale up further, and we need to draw even more sources of funding. So can we attract more international lenders and capital markets to fund the growth of the sector? Conclusion, what I want to say is that the Indian renewables market is very attractive. It offers a multi-decade growth opportunity with a strong policy support from the government of India. On the equity side, the key issue is scale-up capital, scale-up patient capital from sovereign wealth funds, pension funds, and utilities. The key project risks for financiers are, as I said, grid curtailment, offtake and payment risk, and finally, the rupee depreciation risk. With that, I'll end my presentation, and I'll move on to the panel. So, Danish, when I look at financing for the sector, I think of 3 main issues. One is the liquidity. Is there enough liquidity in the system, in the banking system, capital markets, equity, to be able to fund these projects? Second is cost of capital, and the third is structure and risk that is being passed on to the various entities. Can you address the liquidity question? Because, one of the key concerns for us has been that all these projects are being funded in India. Do the Indian banks really have an appetite? I think that's something that Jose also mentioned in the last panel, sure. To fund 15 gigawatts of renewable assets every year.
Yeah. Over the, if you just see the numbers over the last 4 years, I think to the sector, so far the banks have stepped forward in lending. Nobody thought that, we will be able to kind of, financially close more than 10 gigawatts of capacity in a financial year, and that we have done. And it may be noted that this is only on the back of domestic banks. The international banks are mainly absent from the long-term lending market because they don't have a long-term, rupee book in that sense. I think so. There are a couple of factors to play. So obviously, the lenders have become much more comfortable with the solar story. The lenders are obviously much more mature. They don't understand the technology. But yes, there is a big macroeconomic advantage which we had, which is essentially over the last 4 years, rest of the capex sectors of the Indian economy have been virtually dormant. So in that sense, solar was the only sector which was seeing fresh capex. The banks have been flushed with liquidity. We are in a declining interest rate scenario. So yes, the sector has been lucky in that sense. Yes, one needs to now see that once the other sectors of the economy, mainly the steel, we have seen roads also seeing some revival. Once the other capital intensive infra sectors starts picking up, then solar needs to start then competing for capital in that sense. So that will be something to look out for. I think so your question on risks, on cost of funds and liquidity, so you need to understand India is a bank-driven debt market, but therefore banks need to, also churn their portfolio. And obviously the logical market where such a large amount of funding can be churned, let's say post the commissioning, has to be the debt market and the bond market essentially, which in India has its own challenges. And I think that once we can address the risk portion of it, we can see, so we have obviously started seeing transactions both on a credit enhanced basis and on a normal operational kind of project level refinancing happening to the bond market. We see that this needs to increase, but for that, I think what this needs to happen is we have addressed one set of risks. So, we all know what are the risks on the execution side, and more or less, I think we have been able to, the success story is there. Now I think what we need to do is reduce the risk on the operating assets. And once we are able to reduce that risk to purely, to say that an operating renewable asset in India is as secure as you can get, then you get the bond markets and the yield and the pension investors start opening up the purses. So, you need to move from a private equity play for renewable assets to a pension play for renewable assets. And the key there is reducing the risk. So, no uncertainties around payment cycles, addressing the offtake and the curtailment issues. Sure. I think that's the next step where we see the liquidity issue. What would be the key channel? Sure. And that actually impacts the capital market view as well. So once again, once you have, once a long-term yield investors start getting attracted to this, then you see the equity cycle and the equity capital also getting involved.
Sure. Okay. Thank you, Danish. Can I ask Anand and Krishnan, to answer the issue of equity availability for the sector? In particular, how are we going to find patient, long-term equity for the sector? Is there enough appetite, and what needs to happen? I mean, I think Danish touched upon it briefly, to make these people come to India and really devote big checks for investment in the sector.
I'll start with a different perspective, because we are really talking of financing India's renewable energy. And I'd like to, like Sanjeev said in the earlier thing about rooftops, I honestly feel India's renewable energy is not restricted to large grid power, wind and solar. If we really have to meet our 2 degrees C, there'll have to be a huge distributed architecture for energy production and consumption. That will include electricity for sure. It'll include heating, cooling, and cooking. It'll include mobility. Now, if I was to take it from that, and the market drivers out there are really going to be energy access. The cost of delivering, whether it's electricity or whether it's, LPG or, a petroleum product or anything to about 840 million people that are going to live in rural India even in 2030. If you look at it from that perspective, honestly, we have removed the off-taker risk. We already have a priority sector lending of 15 crores at 150 million, about $2.25 billion. So you're really looking at a project size of about $3 million, which honestly speaking is fairly adequate if you're going to have a distributed architecture in the context of electricity, in the context of, even mobility, whether it's bio-CNG, whether it's some of the advanced biofuels. I'm not talking now of a second-generation biorefinery. I'm talking of, pyrolysis. They are just like electrochemical technologies we believe are maturing towards storage. Believe me, biochemical and thermochemical technologies are rapidly growing, not out of the demand for electricity, for the demand for replacing bioplastics and petrochemical products from bioplastic and biomaterials. So I personally feel that the appetite for these kind of projects will grow. And when you're going to be talking of equity requirements which are relatively smaller, another thing is that one of the drivers for the investors' appetite will have to be, the climate finance, which I presume will be spoken of. But suppose we don't have a National Clean Environment Fund, for whatever reason, there needs to be a replacement for it. We need to make our demands on Green Climate Fund. If that is there, I believe the IRR of these projects will be good, and the appetite for equity for these projects, and I'm including the rooftop solar under this category, will be very, very high.
Okay. Anand, do you want to touch upon
Thank
that?
you. I might sound a bit negative, but I don't think India is ready for the equity capital needed for the quantum of solar technology, farms you're looking at. If you see where India stands today, we've had domestic developers look at the market. We've had international investors standing behind domestic developers looking at the market. There is not a single major international developer looking at the market. So I remember a slide which you had shown where you had shown your international developers in India. If you see, most of them sold off and gone. So I think that's where the issue lies. India today does not have access to long-term equity capital. Most of the capital which you see is short-term, as you rightly said. Most developers want to invest, commission, and quickly rotate the capital. For the sector to grow, it needs long-term capital. It needs players who can hold equity for 15 to 20 years and sizes of over a few hundreds of millions of dollars each. So I think India has a long way on the equity funding side. If I can just add there, if you see, a lot of it is also because of the way the sector has evolved. And again, may sound a bit pessimistic, but the way the whole contractual framework works for these projects. There has been a very positive step where SECI has been creating these solar farms and buying the land and establishing the transmission line. So that has de-risked developers from land acquisition and transmission issues. That's a very big step forward. But if you still even see now, the PPA has basic gaps, basic gaps around termination payment protections, and basic gaps around other force majeure events, which cause international developers concern. And what has also happened is, because of the follow-on effect is, when you take these PPAs to the Indian banks, you'll see most lending, which has been done by Indian banks, has a corporate guarantee overhang around their lending. That is not what international developers like. International developers like clean, pure, non-recourse financing. They don't want to saddle the balance sheet for 20 years for the equity and debt. So I think there are some of these things which really need to evolve for India to be able to attract the amount of direct capital, as I said, direct capital, needed to develop the sector.
Sure, okay. Well, we do have some international investors here who are happy to write checks for projects which are ongoing. Okay, I totally understand. There are all these challenges, and financing is something which is still a work in progress. Just moving tack from the utility scale to the distributed sector, that is a sector which is still in a very early stage of its growth, as Sanjeev talked about. There are actually the financing challenges on the distributed solar side are even more acute, because banks have so far not really equipped themselves to provide financing to the sector, although there is a lot of concessional funding now from World Bank, ADB, and KfW coming in there. And MNRE is working with OPEC to launch another facility. Girish, do you want to just tell us about how you are looking at the distributed sector solar financing and how that would change the market dynamic for the sector for this?
Okay. So just to give context, the rooftop solar target for India is around 40 gigawatts that Mr. Tripathi mentioned. And if you look at where we are today, we are about 1 gigawatt, which means in the next 5 years, we need to do 39 gigawatts. It's a huge order. and we did some analysis early on to look at what the barriers are. And one of the key barriers is this availability of debt finance, getting debt into the market. The developers are simply not getting debt fast enough. And there is a lot of public sector schemes that have been announced, but the debt is not flowing yet. So before I get into a particular solution, I also wanted to situate this in the context of what we call as the India Innovation Lab for Green Finance. We have heard a lot about risks in the sector, but at some level the focus has to shift towards creating solutions. And the India Innovation Lab for Green Finance is essentially looking at innovative financial solutions, financial instruments in response to the needs of the clean energy sector in India. And the idea is to not only just talk about ideas, but to create prototypes that are implemented on ground. And we run it through a very transparent public-private partnership kind of process. And the focus is that within a 1 year's time frame to produce these prototypes that can be actually implemented on ground. And out of the India Lab process, knowing this particular risk of debt finance, and it's not only that the debt is not available with the banks, is how do the banks basically lend to the eventual customer and make sure that the debt is given in a timely manner. There is an instrument that came out of the India Lab called the Rooftop Solar Financing Facility that is proposed by IFC. IFC is currently in the process of implementing that, and they'll put the pilot in this year. And the idea is simply to, not, in some ways it's competing with a lot of these other concessional finance facilities in the market, but the focus is to how do you provide debt in a very fast, expedited manner to the developers who are looking for debt. And there are multiple innovations there, and one of the innovations is that the debt is provided to the developer at an aggregated level so that you don't have to worry about debt finance at a project level. And I'm happy to say that IFC is moving forward with that, and the idea is to pilot that towards the second half of the year. Now, another interesting thing about this particular facility is not that it's just providing capital debt finance to the rooftop sector, but it's also designed to do something that Vinay had talked about. At the end of the day, for all the finance to come into this sector, and we did some analysis early on, and there are numbers are different, but the key message is that to get to India's targets, we will, if we just rely on the traditional sources of financing, we are likely to fall short by approximately 30%, both in debt and equity, okay? And that means the debt and equity has to come from so-called institutional investors. And these are investors which are pension funds, insurance companies, sovereign wealth funds, etc. And how do you attract them? And there, the issue of the size of the transaction, the issue of liquid instruments becomes very important. And so in this, the reason I talked about this is, in this particular facility, on the back end, the idea is to securitize these assets and take them to what Danish was talking about, to the bond market, right? So not only you're starting addressing the issue which is there right now, which is to lend to small projects, but at the end of the day, we want to attract these large investors, and the facility is going to do that. So that's just one of the examples of the India Lab. Happy to talk about others as well.
Sure, okay. So we are talking about reducing the risk, we are talking about increasing the scale of these assets, we are talking about creating new financial instruments. Vivek, you do a lot of work with the government. What do you think is realistically possible? What can the government do, and what are you advising the government in terms of making some of these things happen?
Sure. So let me, most of the issues have been discussed, and we have been also working very closely with the government on trying to address those issues. What is more realistic, if I have to talk about? See, we are talking of something of 175 gigawatt by 2022. We have done some assessment where we think that additional 50 to 60 gigawatt, which includes, somehow we have not discussed of wind at all. But including wind as well as solar is something which we feel that will be less prone to risk in a grid size of, if I have to project the demand, and there is a demand of around 235 to 216 gigawatt. Recently CS submitted those numbers. So in a grid size of, say, peak demand of 216 to 235 gigawatt, how this entire new 175 gigawatt story will fit in will be area of concern, and therefore your risk flowing is both in terms of the curtailment potential risk as well as the payment capacity of the DISCOM. We have been advising to the government on two accounts there. One is that certainly on the payment side, there is a Uday scheme which is there. So we are trying to specifically point out that the states now need to catch up. There is a scheme in place. There are a lot of targets which they need to achieve. If those targets are not achieved, then there is a concern which we can again see with DISCOM will face. Having said that, I think right now the critical thing is that the regulators need to follow the Uday scheme in spirit, which includes that there has to be some regular tariff increase which is required. Because any RPO compliance, the new capacity, even if it is 4 or sub 4 we are talking of, the overall APCC and the cost of power, according to us, is still required to go up on the retail consumers. So that will help the DISCOM, and that is what we are telling to the state governments to do that, along with the operational efficiency which they have to achieve. The second bit part is, I think there's no question that we should not relook at the PPA. I think Krishna also mentioned, and earlier from FRV also they mentioned that if you want to take a long-term view, the contract has to be strong and robust and standalone enough to, do a recourse financing. The concern right now is there is no clarity on the curtailment part. As I am saying, the more and more we add to the grid, the commercial call for a DISCOM will always be to buy RE power, not from today. Let's see, today is a focus with a push from the government. We don't know 3 years down the line or 2020 what will happen. So if that push is not there, there will be choice between buying from solar, say 4.5 or maybe lower, and versus a fixed charge which they have already paid for thermal. So there is a commercial call which a DISCOM will take, and somewhere that has to be watertight in the agreement that this must-run status should be strictly adopted. And that is where, we are also, when we work with the financing, I don't see per se money is an issue both in equity, because you will, as you rightly mentioned, a lot of players even on the equity side now in India who are looking at, maybe they are not the first one to come, but they are the second one and trying to closely look at the market and now invest. But yes, there is a ample equity interest available. There is a debt domestic available, as Danny also pointed out, and international also they are keen to invest, provided we have certain consistent policy framework for a long-term view which addresses the realistic offtake which will be done by DISCOM. I'm using the word realistic because we have some concern on 175 gigawatt being realistic, and the DISCOM appetite to pay and those consumers in an assured manner. I think these two things need to be the paramount focus from the government side to ensure that the investors are there to invest. Yeah.
Sure. Okay.
Thank you.
Mr. Tripathi has just kindly pointed out that, of course, the government of India is aware of, what are the key challenges and the situation on the ground in terms of financing. And there's a lot of work going on at the government's end. I mean, just to kind of list out a few initiatives, there is a $1 billion equity fund being funded and set up by the government, and they're inviting other large international investors to participate in that fund and grow the size of that fund. Second, the government has accorded renewables the status of priority sector, which means banks get some incentives and reduce the cost of capital when they're funding renewable energy projects. And third, the government is actually monitoring on a monthly basis how these banks are providing funding to the sector. They've all been given targets, they've all given individual commitments back in Reinvest 2015, and these banks are being monitored on that. So there is actually a lot of thrust at the government, at the MNRE's end, to provide more and more financing for the sector. One of the other issues which I briefly talked about is the rupee depreciation risk. You could argue that it's been a long time, we have enough historical data, you can build it into the price, etc. But I think it is also a key to bringing the cost of capital down in rupees for the Indian projects. The government has talked about having dollar-denominated tariffs, but nothing has really kind of come out of that so far. Is there a way, are there any structures or any other ways to mitigate the rupee depreciation risk and to make it provide more comfort to the international investors?
Yeah. See, on that, I think so. What we can, what we can say with certainty is, India today is a large opportunity market. I think that everybody knows. If international developers or investors are looking to participate in the Indian renewable energy story, they need to take a long-term view and not necessarily a 1 to 3 year kind of a view. And once you are committed to a long-term view, what you will, obviously, anyways, Indian currency has been one of the best performing emerging markets currency over the last 12 to 18 months. But I think what you need to understand is, from an equity side, today there are no financial products available to hedge a 15-year currency risk. So I think as a developer, the Indian market is now deep enough to track long-term capital. Come with a view of kind of investing dollars into the Indian economy, reinvesting the profits again into India. And what you will realize is, even though the short-term currency hedging rates tend to be a bit higher because of the volatility concerns, maybe in the region of 6 to 7%. If you take a long-term last 20-year average, you are only looking at a 3.5% kind of a dollar depreciation. And if you want to bet on the fact that India is on track to achieving its renewable energy goals, today the single biggest import that India does is crude oil. If we are able to reach our COP21 targets, this big import requirement goes down, which anyways helps the currency in the long run. Okay. So I think that we have seen a lot of foreign developers now taking the transition from being a trading kind of a mindset to a long-term investment.
Sure. We are running out of time. Just a quick word to Girish on that.
Yeah. I was hoping you would ask this question. I mean, I can talk about it for hours, but I just want to add a quick point here. Currency hedging, it does come up in every discussion. Every time I met Mr. Tripathi, he said, do you have a solution for currency hedging? And I am happy to report, and I should have mentioned earlier that the India Lab actually is endorsed by MNRE, and what we are producing out of the India Lab is actually, it's an innovation that's supported by Ministry of New and Renewable Energy. And out of the first cycle of the India Lab, we have an instrument that basically looks at this problem. I mean, we have a couple of solutions, but one of the solutions is essentially to focus on what we call tail risk. It's a tail risk guarantee product. And the idea is that, if you think of currency hedge, and if you claim that currency hedges are expensive, that means you're saying that the market is not pricing currency risk appropriately, which is not correct. Markets are pretty efficient. The real trick here is to say, hey, we will use some public finance, right? Because we think the sector is important, we want to reduce the cost of capital. The real question then becomes is, how can we use public capital the most efficient way? Which is to say, how can I leverage public capital in the best way possible? And obviously, I have some folders here with a lot of information. Happy to talk to people about that. But this tail risk guarantee product, what we have shown is that with a leverage of about 10, that means every $1 of public money can bring in, $10 of private capital. You can achieve this currency hedging product, which will reduce the cost of hedging by 30%. And not only that, the trick is that when we design this product, the idea is that if there's a currency upside, right, you want that benefit to return to the public sector. And this facility will return with a very high probability that upside to the public sector, so that this kind of public money can be reinvested in other important things. So there are initiatives like that are coming out and out of the India Lab. So that is a very, very proud moment for us.
Sure, Girish, thank you. So I think in conclusion, I would say that the Indian renewable sector is a very exciting opportunity for investors in India and abroad. The sector is growing robustly. There is a huge amount of government support, political commitment to the sector. There are obviously challenges, but many investors, having done their research over a period of time, have got comfortable with the risk profile of these projects. More work needs to be done, but the sector provides huge growth opportunities, and we believe that the risk profile of these projects will improve as we go along. With that, we will conclude the session and thank my panelists. Thank you. you.